Peter, welcome to the show. A quick introduction about yourself and how you got into the space.
Yeah, sure. Thanks. I'm Peter Armand, the founder and CEO of AF Capital, an international investment boutique and advisory firm. And also, I'm a founder and CFO of a couple of portfolio companies in high-tech telecommunications and the internet media space. I've got a background in computer science and then finance, as well. Many entrepreneurs in this area and in this era. So we're an investment firm right now looking at high-tech investments. We do advisory on private equity and VC, and also have own portfolio investment into a cloud marketplace promising startup. So I think I'm better positioned to talk about marketplace startups and that space rather than food tech or travel or transportation. Anyway, thanks for the invitation. Happy to join the panel.
And with that being said, I mean, Peter, I want to come to you. On the marketplace side, I know you've had a lot of investment experience and the engineering background, but let's talk about how we're buying this stuff. I mean, marketplaces dramatically changed in the past 2.5, 3 months in almost every area of the world. How we buy our food, how we buy our products, how we buy everything. But when it comes to these areas, I mean, what are you seeing that has shifted from the investment side in marketplaces?
I would say that regarding marketplace niche, we see a high input from and on a traditional B2C businesses, which are currently trying to very quickly digitize as many sales as possible, right? And trying to become online e-commerce B2C businesses rather than offline. And otherwise, they simply will not survive. That is why they invest in marketplace integrations and product information management systems, logistics system, and so on. And some companies even start their own marketplaces to adapt to supply chain challenges and maximize their return on investment ratio on online consumers, which is new revenue for them. All that makes marketplace models very attractive for VCs right now. However, what has changed during the pandemic? Previously, the VC-backed marketplace companies were quite limited with experimenting on its product fit and market fit on the real customers, right? But they still were allowed and were cash-backed to do so because of necessity to find the niche. And right now, a very large part of VCs only review projects very relevant to COVID crisis. And namely marketplaces for education technology, remote technology, telemedicine, health tech, and a few others. In other words, all hot sectors in high tech right now. But in the meantime, a large part of VCs, especially well-known with large capital, haven't changed investment preferences because they are oriented on long-term average profitability for investors. They just have now more potential deals on table, and funding cycle may become even longer. Mm-hmm. That's specifically to marketplaces. For us, some also general observations about the market in general. Can share a few if you do. I see two trends. One is that everybody is talking about, and another is not that evident. The trend number one is that number and volume of deals decline, but there are more investable companies right now in the market. So right now there is a huge decline in the number of new deals, and investors have much more options for fund allocation because many companies which were previously avoiding new rounds because of sufficient growth funding from revenue, they are now totally unsure about market performance and need to have capital for at least 1 or better 2 years of operations and development. And trend number two is that many of you as well believe that COVID and after COVID recession is the best investment time for seed and angel investments. And they usually refer to the previous Great Recession of 2009, during which were founded many of today's unicorns, WhatsApp, Uber, Slack, Square, to name just a few. But we don't have to draw the same conclusions now in 2020, 10 years later. And I think that because of recession, there will be lack of competition and discoveries of blue oceans with new businesses. I don't think there will be a lot of them. The previous recession of 2009 coincided with the launch of first iPhone and the start of mass market smartphone era. So that unlocked the network effect for business models of many new startups at that time. So now, as the ecosystem of Apple and Google are well developed and the mobile application market is formed and absolutely different now, it may be a start of new wave of unicorns, of course, but the source will definitely be different.
Yeah, I mean, I think, Peter mentioned it as well as, great companies are made during these times, and it's not the time to sit by the on the sideline and just kind of hang out and wait. It's the time to get out there and just build and go as much as you possibly can, right? These are the times to do it in, because hopefully times like this will showcase what's the future in the next 10 years and ahead are going to look like, and redefine where we go. And with that being said, Peter, I want to start with you. I mean, kind of your closing thoughts. Where are we going with all of this, right? Marketplaces, with food, with transportation. How have things changed, and where do you see the next 3 to 5 years kind of shifting out in these areas as well?
Yeah. So I see that both sides, founders and investors, so see the picture. I'm also from Russia. From one crisis to another, we have a back-to-basics situation there every 4 to 5 years. So I think we're quite skilled at survival in tough times. So at all times, and especially during those times, for investable companies, there is one thing that matters most: how quick a company can test new hypotheses and implement successful ones, right? And a company must be ready to do a pivot, even significant, to keep the company alive and investable. And there's a lot of new opportunities and doors opened, along with major risks and threats arising. And the fastest will survive and will be successful. That is a universal rule, and it will be especially applicable in the next 2 to 3 years. So, there are some recent pivot success cases. I can describe one such successful pivot case in marketplaces. Not sure about FoodTech. I'm pretty sure there are many more. In marketplace, because of changed investor preferences towards more anti-COVID businesses, some startups are now struggling to raise VC money for marketplace growth. In fact, how to raise money for your marketplace also depends on how do you solve the classic marketplace chicken and egg problem. Which part of your marketplace, suppliers or buyers, to develop first. And VC funding may possibly be the only option if you scale both sides of the platform at the same time. But there are other ways, such as setting out to dominate a niche first and expand from there. And one company under my supervision recently decided to change the growth strategy and pivoted towards explosive growth of demand by participating in joint venture with its anchor clients, aiming to go global in the short term, and aiming to build from there the supply side, also globally, to cover the demand, switching over time the supply from external providers to supply available at home marketplace. So, yeah. There's another recent investment case of shifting to online businesses. So in marketplace niche, VC largest funds are now making big bets on vertical industry-specific B2B marketplaces. So the first wave was kind of 20 years ago during dot-com bubble. And early players were consolidated by Alibaba, eBay Business, and similar players. You all know these names. And now it's the second reincarnation of that wave. And it's obvious why. Because many supply chains will be disrupted by supply-side bankruptcies and topped with transportation crisis created by the same reasons. Many buyers and sellers will prefer to be more flexible in finding a counterparty for transaction. And also the new criteria for B2B procurement in post-COVID will be not good value for money as it used to be, but rather price for functionality. Because the profit margins will be squeezed all along the supply chain and buyers will be looking for a lower price for same functionality. And there is no more room for the luxury of premium pricing. It's basically not affordable no longer. So as a recent case of investment in this sector, a month ago, Bain Capital disclosed a deal with Material Bank, which raised $28 million in round B. I'm pretty sure we'll soon see new examples in B2B marketplace.